For 100 years, the financial world has operated on a single, unshakable assumption. It is the bedrock of every pension fund, every central bank, and every investment portfolio on the planet. That assumption is this: the United States government always pays its bills. United States Treasury bonds were considered risk-free. They were the gold standard of safety. If the world was burning, you bought treasuries. If banks were failing, you bought treasuries. It was the one asset that could never fail, because it was backed by the full faith and credit of the world's only superpower. But what happens when that faith is broken? We are no longer dealing with a theoretical scenario. We are living through a historical pivot point. In May 2025, Moody's Investor Service, the last of the big three credit rating agencies still holding the line, stripped the United States of its pristine AAA rating. This was not an accident. It was the final act in a trilogy of failure that began in 2011 with Standard & Poor's and continued in 2023 with Fitch. Today, for the first time in modern history, America is rated below the top tier by every major agency that matters. The media calls it a downgrade. History will call it a financial earthquake. We are witnessing the erosion of U.S. sovereign stability. We are watching a nation with $38 trillion in debt, where interest payments now consume more tax revenue than the entire defense budget. We are seeing major banks like J.P. Morgan and Wells Fargo downgraded in the wake of the government's fall. The collapse has started. It is not a sudden crash that happens on a single Tuesday morning. It is a slow, structural grinding of the tectonic plates of the global economy, and when they finally snap, the shockwave will touch every dollar in your pocket. Welcome to the Financial Coin Historian. Today, we are conducting a forensic investigation into the death of America's credit rating. We will analyze the numbers Washington doesn't want you to see. We will explain why the sovereign ceiling is crushing the banking system. And we will ask the ultimate question: if the US dollar is no longer risk-free, is your money safe anywhere? To understand the magnitude of this moment, we have to look back. The collapse of America's creditworthiness didn't happen overnight. It was a slow erosion, a cancer that grew while the patient, the US economy, appeared healthy on the surface. This is the story of the Downgrade Trilogy. Act 1, the S&P shock, 2011. The first crack in the dam appeared in August 2011. The United States was in the middle of a political firestorm over the debt ceiling, the legal limit on how much the government can borrow. Republicans and Democrats were playing a game of chicken, threatening to let the country default if they didn't get their way. Standard & Poor's, S&P, one of the three major rating agencies, had seen enough. On a Friday night in August, they did the unthinkable. They downgraded the United States from OAA to AA+. The world gasped. The stock market plunged. The S&P 500 fell nearly 7%. It was a humiliation. But at the time, many dismissed it. They said S&P made a math error. They said the other agencies, Moody's and Fitch, still held the U.S. at AOA. They said America was still the cleanest shirt in the dirty laundry basket of the global economy. But S&P was right. They cited political brinkmanship and a failure of governance. They warned that America's political system was becoming too dysfunctional to manage its finances. They were 14 years early, but they were right. Act 2, the Fitch warning, 2023. Fast forward 12 years. The debt had exploded from $14 trillion in 2011 to over $32 trillion in 2023. Another debt ceiling crisis paralyzed Washington. This time, it was Fitch Ratings that pulled the trigger. On August 1st, 2023, Fitch downgraded the U.S. from AAA to AA+. Their reasoning was explicit and damning. They cited an erosion of governance over the last 2 decades. They pointed to the expected fiscal deterioration over the next 3 years. Fitch was warning the world that the U.S. government was addicted to deficit spending. Even during peacetime, even when the economy was growing, the U.S. was borrowing trillions. This is a violation of basic economic logic. You're supposed to pay down debt when times are good, so you can borrow when times are bad. America was borrowing always. Act 3, the Moody's verdict, 2025. And then came the final blow, May 2025. Moody's was the holdout. They had kept the U.S. at AOA, their version of AOA, long after the others had given up. They were the last shred of credibility the Treasury had. But the math simply became impossible to ignore. In May 2025, Moody's downgraded the U.S. sovereign rating to AA1. Why? Because of interest rates. The Federal Reserve had raised rates to fight inflation, and those higher rates turned the national debt into a weapon of mass destruction against the budget. Moody's noted that debt affordability had collapsed. The U.S. was no longer just borrowing to build roads or fund the military. It was borrowing to pay the interest on the credit card. With this final downgrade, the trilogy was complete. The United States is no longer a point-to-OAA nation. The market's psychological safety net has been removed. We are now living in a world where the U.S. government is officially considered a credit risk. Let's strip away the politics and look at the fiscal pathology. Why did these agencies really downgrade the United States? It wasn't because they hate America, it's because they can do math. The $38 trillion mountain. The gross national debt has surpassed $38 trillion, but big numbers are abstract. Let's put this in perspective. The debt to GDP ratio, the measure of what you owe versus what you produce, is projected to reach 122% by the end of 2025. This is wartime leverage. The US usually only sees these numbers when fighting a world war, but there is no world war. This is self-inflicted financial injury. The interest explosion. Here is the most terrifying statistic of the entire crisis. According to the St. Louis Federal Reserve and the CBO, in 2020, the U.S. government paid about $514 billion in interest on its debt. By the first quarter of 2025, that number had exploded to over $1.1 trillion. That is a doubling of interest costs in just 5 years. Think about your own household. Imagine if your mortgage payment doubled in 5 years, but your income only went up a little bit. That is the state of the U.S. Treasury. Interest payments now consume approximately 34% to 35% of all federal tax revenue. For every dollar you pay in income tax, 35 cents goes straight to bondholders. It doesn't buy a single bullet for a soldier. It doesn't pay for a single doctor visit for a senior citizen. It doesn't fix a single pothole. It just pays for the privilege of having borrowed money in the past. This is what economists call fiscal dominance. The debt is now so large that it dominates every other decision. The government cannot spend on new programs because the interest bill is eating the budget alive. The revenue problem. The rating agencies also looked at the revenue side. The U.S. tax system is broken. The 2017 Tax Cuts and Jobs Act reduced revenues significantly. Moody's estimated that extending these tax cuts would add another $4 trillion to the debt over the next decade. The political system is paralyzed. One side refuses to raise taxes. The other side refuses to cut entitlement spending like Social Security and Medicare. The result is a structural deficit that never goes away. The U.S. government is running a deficit of nearly $2 trillion a year, just to keep the lights on. This is why the downgrade happened. It wasn't a punishment, it was a diagnosis. The patient has a terminal spending addiction, and there is no political will to cure it. You might be asking, if this is such a disaster, why didn't the stock market go to zero the day after the downgrade? This is where the term financial earthquake comes in. Earthquakes have foreshocks, the main event, and aftershocks. The downgrade was a structural shift deep beneath the surface. The yield spike. The immediate impact was seen in the bond market. When a borrower's credit rating falls, they have to pay higher interest to attract lenders. Following the Moody's downgrade, the yield on the 30-year U.S. Treasury bond jumped above 5%. This is the risk premium. Investors are saying, if you want me to lend you money for 30 years, you have to pay me more, because I don't trust you as much as I used to. Higher Treasury yields are the earthquake that shakes the whole city. Why? Because the Treasury yield is the risk-free rate for the entire global economy. The ripple effect. When the Treasury yield goes up, everything goes up. Mortgages. Mortgage rates are directly tied to the 10-year Treasury. When the U.S. government pays more, you pay more for your house. Mortgage rates spiked, freezing the housing market. Credit cards. The interest on your credit card is pegged to these rates. American families are now paying record high interest on their personal debt. Corporate debt. Businesses borrow based on Treasury rates. If it costs the government 5% to borrow, it costs a company 7% or 8%. This kills business expansion. It kills jobs. The downgrade acted as a permanent tax increase on the entire American economy, enforced not by Congress, but by the bond market. In October 2025, shortly after the sovereign downgrade, something terrifying happened in the banking sector. Moody's and other agencies began downgrading the credit ratings of major U.S. banks, J.P. Morgan Chase, Bank of America, Wells Fargo. Why? These banks are profitable. They have trillions in assets. Why punish them? It is because of a principle known as the sovereign ceiling rule. In finance, the theory is that no company in a country can be safer than the country itself. If the government collapses, the banks collapse. Why? Because the banks hold the government's debt. The balance sheet. Poison American banks hold trillions of dollars in U.S. Treasury bonds. They bought these bonds when interest rates were low. Now that rates are high, driven higher by the downgrade, the value of those old bonds has crashed. If you bought a bond paying 1% interest and new bonds pay 5%, nobody wants your old bond. Its value drops. This created a massive unrealized loss hole in the banking system's balance sheet. We saw a preview of this in 2023 with the collapse of Silicon Valley Bank. The 2025 downgrade made this problem systemic. By downgrading the banks, the agencies are warning us the foundation is cracked. If the US government faces a fiscal crisis, it cannot bail out the banks because the government is the crisis. The Fed put, the idea that the Federal Reserve can print money to save everyone, is broken because printing money causes inflation, which drives rates higher, which crashes the bonds further. It is a trap. The damage extends far beyond Wall Street. The credit downgrade is a geopolitical signal. It tells the world that the exorbitant privilege of the United States is ending. For 80 years, the US enjoyed a unique advantage. It could print dollars to pay for oil, for wars, for imports. The world accepted those dollars because they were good as gold. They were EOMS now. They are AA1. They are AA+. They are risky. The rise of gold in the East. This is why we are seeing central banks around the world buying gold at the fastest pace since 1967. China, Russia, India, Poland, Singapore. They are dumping treasuries and buying gold. Why? Because gold cannot be downgraded. Gold does not have a credit rating. Gold does not have a CEO or a Congress that can default. The BRICS nations, Brazil, Russia, India, China, South Africa, are watching this downgrade with glee. They are building alternative payment systems. They are settling trade in yuan and local currencies. The US downgrade validates their argument. The dollar system is unsafe. The Americans are broke. Come join our system. The downgrade accelerates de-dollarization. It doesn't mean the dollar dies tomorrow, but it means the dollar slowly loses its monopoly. And as demand for dollars fades, the US loses its ability to export its inflation to the rest of the world. The inflation comes home. So where does this road end? When a nation loses its credit rating, faces spiraling interest costs, and refuses to cut spending, there are only two mathematical outcomes. Option 1, the hard default. The government admits it can't pay. It tells bondholders, sorry, you get 50 cents on the dollar. This is unlikely for the US. It would destroy the global banking system instantly. It would cause a depression worse than 1929. No politician will choose this if they have a printing press. Option 2, the soft default, inflation. This is the path of least resistance. The Federal Reserve prints the money to pay the debt. The government owes $38 trillion. Fine. We will print $38 trillion. The debt is paid. But the value of the dollars used to pay it is destroyed. This is financial repression. The government keeps interest rates below the rate of inflation. They steal the value of your savings to pay off their own mistakes. The credit downgrades of 2025 are a signal that the market believes option 2 is coming. The rating agencies know the US won't stop spending. They know the only way out is to inflate the debt away. The collapse has started, not with an explosion, but with a notification from a rating agency. America has moved from being the world S banker to the world not S biggest debtor with a credit score that is slipping. This financial earthquake has changed the ground beneath our feet. For the homeowner, it means the era of 3% mortgages is gone forever. For the saver, it means your cash is melting in a fire of inflation caused by debt monetization. For the investor, it means the risk-free portion of your portfolio is now the source of the risk. The rating agencies have spoken. The political system has failed to answer. Now the market will impose its own discipline. And the market is merciless. This is the financial coin historian. The warning bells are ringing. Are you listening?